Imagine it's a Saturday morning in the spring of 2026. You're standing on a manicured lawn, looking at a charming three-bedroom house. It's nothing fancy, maybe 1,500 square feet, a decent backyard, and a kitchen that was renovated 5 years ago. The price tag? An even $500,000. 10 years ago, this was a mansion. 5 years ago, it was a solid upper-middle-class home. But in 2026, this is the new entry point for the American dream. You pull out your phone, open a mortgage calculator, and plug in the numbers. And that's when the realization hits you like a ton of bricks. The number staring back at you isn't just high, it's physically painful. Hey everyone, I'm Alex, and today we need to have a very serious, very honest conversation about the future of housing. We've all been waiting for the market to cool down or for some massive crash to make things affordable again. But as we look toward 2026, the data is telling a different story. The math behind owning a $500,000 home is becoming so brutal that it's creating a massive divide between those who can play the game and those who are being locked out forever. Today, I'm going to break down exactly what it takes to carry a $500,000 mortgage in 2026. We're going to look at the hidden costs that most people ignore, the salary you actually need to survive, and the hard truth about who will actually be able to sign those closing papers. This isn't about scaring you, it's about preparing you, because if you want to own a home in 2 years, you need to understand the math today. Let's start with the biggest hurdle of them all. The down payment. For decades, the gold standard was 20%. On a $500,000 house, that's a cool $100,000 in cash. Think about that for a second. In 2026, with the cost of groceries, car payments, and rent still hovering at historic highs, how long does it take the average person to save $100,000? Even if you're a superstar saver, putting away $1,000 every single month, it would take you over 8 years to hit that goal. And by the time you reach it, that $500,000 house might be worth $600,000. It's like running a race where the finish line keeps moving further away the faster you run. Now, I know what you're thinking. Alex, nobody puts 20% down anymore. You're right. Most first-time buyers are looking at 3.5 or 5%. But here's the brutal math part of that scenario. If you only put 5% down, you're borrowing $475,000. In 2026, we have to be realistic about interest rates. The days of 2 or 3% interest are gone, likely for our lifetimes. Even if rates settle into a moderate 5.5 or 6%, your principal and interest payment alone is going to be roughly $2,800 a month, and we haven't even touched taxes or insurance yet. This is where the hidden vampires of real estate come in. By 2026, property taxes in many states are projected to be significantly higher as municipalities catch up to the massive price surges of the early 20s. Let's be conservative and say taxes and insurance add another $700 to your monthly bill. Now you're at $3,500 a month. But wait, there's more. If you didn't put 20% down, you're paying private mortgage insurance, or PMI. Tack on another $150. Now we're at $3,650 a month. And we haven't even turned on the lights or mowed the grass. When you factor in utilities, basic maintenance, and the inevitable something broke fund, you are easily looking at a $4,000 a month commitment. Now let's apply the golden rule of personal finance. Your housing costs shouldn't exceed 30% of your gross income. To comfortably afford a $4,000 monthly payment, your household needs to be bringing in $13,300 a month. That is a yearly salary of $160,000. Think about that number for a moment. $160,000 a year just to afford a starter $500,000 home. According to current data, that puts you well into the top 15% of earners in the United States. So who are these people? Who can actually afford this in 2026? The first group is what I call the equity rollers. These aren't first-time buyers. These are people who bought a home in 2015 for $200,000, saw it double in value, and are now sitting on a mountain of equity. They aren't saving $100,000 for a down payment. They're just transferring it from their old house to the new one. For them, the math isn't brutal. It's just a lateral move. This is why the gap between homeowners and renters is becoming a canyon. If you're already in the burning building, you can find an exit. If you're trying to get in, the door is locked. The second group is the DINKs, double income, no kids. In 2026, the two-income household isn't just a lifestyle choice, it's a survival strategy. If you have two professionals each making $80,000 a year, that $160,000 target becomes reachable. But here's the catch. That math only works until life happens. If one person loses a job, or if you decide to have a child and suddenly face $4,000 a month childcare costs, that affordable house becomes a financial cage.
The third group, and this is the one that frustrates people the most, is the inheritance generation. We are currently entering the era of the greatest wealth transfer in human history. Millions of millennials and Gen Zers are going to be able to afford these homes because of the bank of mom and dad. Whether it's a gifted down payment or a direct inheritance, a significant portion of the 2026 housing market will be fueled by old money, not new earnings. So where does that leave everyone else? If you don't have a $100,000 inheritance or a partner making six figures, does that mean the dream is dead? Not necessarily, but it does mean the strategy has to change. The brutal math of 2026 requires a brutal level of discipline. We're seeing a shift toward house hacking, where people buy a property and immediately rent out a room or a basement just to offset that $4,000 payment. We're seeing more people move to secondary markets, cities that used to be ignored but are now becoming the only places where a $500,000 house still looks like a mansion. But here is the most important takeaway. The biggest mistake you can make in 2026 is forcing the math to work. When you start stretching your budget to 40 or 50% of your income just to get the keys, you aren't buying an asset, you're buying a liability that owns you. If the water heater blows up or the roof leaks and you have $0 left at the end of the month, that dream home quickly becomes a nightmare. As we head toward 2026, the reality is that a $500,000 house is no longer the standard. It is a luxury. And the people who will afford it are those who are preparing right now, not by wishing for a crash, but by aggressively increasing their income, protecting their credit scores, and rethinking what home actually looks like. The math is brutal, yes, but math is also predictable. If you know the numbers you're up against, you can start building the ladder to climb over them. The housing market of 2026 won't care about your feelings, but it will care about your balance sheet. Start building yours today, because the only thing more expensive than a $500,000 house is the cost of waiting until it becomes a $600,000 house. Keep your head down, keep your goals clear, and remember, the math doesn't lie, so don't lie to yourself about the math. I'll see you in the next one.